Hi, everyone. Welcome to our webinar today. We are just going to give everyone a few more minutes to join before we begin our actual presentation. So we'll be back in a moment. Okay, welcome everyone. Thanks so much for joining us today to discuss ASC 606, Revenue from Contracts with Customers, where we will be covering the who, what, and how of revenue recognition with a focus on private companies. This webinar will honor active participants with 1 CPE credit, and just as a reminder, in order to be considered an active participant, you must answer 4 polling questions and stay engaged for at least 50 minutes. If at any time you have any questions for the host, please submit them via the chat feature at the bottom of the GoToMeeting screen. We will hopefully have some time at the end to answer some of these questions, but if we run out of time, we will be sure to send you an email response to those questions. This presentation has also been made available in the handout section of your GoToMeeting, so if you'd like to download that, it's available as a resource. We do have some awesome presentations planned for you today, but first, let's introduce our host, so you know where our breadth of knowledge is coming from. First, my name is Kristen Lawson, and I am the Revenue Management Sales Engineer at SOFTRAX, an enterprise solution software company here in Boston, Massachusetts. I'm joined today by Dave Lewin, Managing Director and leader of the New England Accounting Advisory Practice at CBIZ MHM, as well as Rob Miller, Managing Director and member of the Accounting and Auditing Group at CBIZ MHM. Both Dave and Rob have over 20 years of experience in the accounting world that they will grace us with today, so thank you both very much for joining me. So just a little background on my company. SOFTRAX is a software business focused on providing leading billing and revenues recognition solutions to enterprise-level companies all over the world. Our traditional clients range anywhere from software and SaaS verticals to healthcare, MediaCom, even ERP systems. And they're constantly evolving due to the new guidance ASC 606. Now, I'm not going to try to ruin our presentation by jumping to the advantages of automating your billing or revenue management systems. So now I'm going to pass the torch on to Dave Lewin to introduce you to CBIZ MHM and begin our presentation.
Good afternoon, everyone, and thank you, Kristen. CBIZ MHM is the 10th largest accounting provider in the nation. We have over 100 offices, including 2 right here in New England, Boston and Providence. From auditing and tax compliance to accounting and tax advisory services, we strive to provide solutions that are on time, on budget, and with no surprises. Our accounting advisory practice, which I lead, guides companies through complex technical accounting matters such as mergers and acquisitions, purchase accounting, periodic routine and complex reporting matters like revenue recognition. We also provide outsourced controllers, CFO, accounting, and internal audit services as well. So today, we're going to provide you an overview of the complexities of the new revenue recognition standard and why it is really important to start thinking about it now. We will go over the timeline for assessment, adoption, and reporting. We'll talk about systems challenges that you may face and the benefit from being proactive in determining if your current system or process can actually handle the requirements of the new standard. Now that public companies have adopted the standard, we have been able to review some of their disclosures in practice and been privy to SEC comment letters on such companies' adoptions. So we have a great platform to help private companies think about the new standard. We will also talk about things that your auditors will be asking for and what you may need to do to get ready for your first audit under ASC 606. Lastly, we'll touch on implementation, approach, and challenges as well. So why is this new standard so important? In certain cases, revenues will be recognized faster than the current standard, and then in other cases, they may be deferred. One example of where you might actually recognize revenue faster under the new standard is when you think about contingent revenues. So if there's certain types of performance bonuses you could earn over the life of a contract, the new requirement actually requires you to make an estimate of what you're going to earn, and if it's probable, you'll actually record some of those revenues before you have actually hit the threshold to earn it. So very, very different than the old standard. When you think about the contracts that you have with your company, it is really, really important to understand the terms of those contracts. Because number one, you may wish to potentially change some of those terms, or as you think about new contracts, you may want to word them differently because of the impact of ASC 606. Certain employee benefit considerations, such as sales commissions, are now required to be capitalized and amortized over the life of the contract versus being expensed up front when it's earned. So very, very different. And a similar treatment is true with contract acquisition costs, where historically they may have been expensed up front, but now they need to be deferred and amortized. Another thing that's really important about the new standard relates to if you actually have a contract, if you meet the definition of a contract, and we are going to touch on that in a bit, but if you don't meet the definition of a contract, all of the revenue actually is required to be deferred until certain criteria has been met. And contract modifications. So as we all know, through the course of business, there are often times when business requires you to modify a contract. So under the new standard, the contract modifications could force you into actually recording that modification as a brand new contract or as a modification to the current one. So again, the devil's in the details. And lastly, as it relates to contract modifications or just contracts alone, the contract does not have to be written. It can be a verbal agreement, and as long as there are enforceable rights and obligations, you could get thrown into the standard. As far as scope exceptions, here's a short list of items that are scoped out of ASC 606. So accounting for leases, insurance contracts, financial instruments, guarantees, and non-monetary transactions. These are all scoped out and covered by other existing GAAP. And then lastly here, if you have sales or transfers of non-financial assets outside of the entity's ordinary course of business, those would be scoped out. So the example we have, if you sell your corporate headquarters and selling real estate and property is not part of your ordinary course of business, this would be scoped out of the standard. So at this point, I'd like to turn it back to Kristen for our first polling question.
Thanks, Dave. So for our first polling question, I'll initiate the question, and then you'll have about 30 seconds to answer. Once we gather all the answers, I'll post the results, and then I'll speak to them for a moment. So the question is, do you expect the new standard to have a material impact? Please select one of the answers, and then we'll gather those results. Almost got 100%, so we'll go ahead and close that poll. And let's see the results. So we have 9% in unknown, 31% yes, 32% maybe, and 28% no. So I really believe actually that people have underestimated the scope of material impact here in this question. If we focus solely on the revenue management side of the equation, obviously materiality is all relative. You know, depending on the length and scope of a contract, these revenue recognition rules may only change the timing of recognition for 1 or 2 products, which ultimately may not affect your bottom line at all. However, if you think about the new standard in terms of overall material impact to a business, I really don't think people understand the breadth of change involved. Here at SOFTRAX, we have prospects that had no idea that a revenue recognition project would cause so much disruption. The time to assess their current and future revenue policies is only the first step in the process. Implementing that new policy means teaching existing personnel, adjusting current processes and controls, and it may even require a new system solution to support those changes because your old systems no longer can, which again means taking on an entirely new piece of the project. Now, if you get ahead of this, you can reap absolutely astounding benefits from this entire evolution. You know, it'll change the day-to-day work of every employee and being able to refocus that energy on business policies instead of data management. But it takes a lot of time, it takes patience, and it takes organization. So make sure you do your due diligence. You know, and that's really what we're here for, is to help you prepare for implementation and ultimately compliance with new guidance. So I'm going to go ahead and move on to our next slide here. Okay, so those were the results that we had previously. So it looks like it's changed since we did this before. But again, if we have 30% in the no category, I really recommend you do some more due diligence. So first, let's back up. You know, what's the timeline on implementing the new standard? The effective date for public companies to be compliant with the new guidance is now, as you can see that obnoxious now on the screen. That means Q1 reports for calendar year end companies should be compliant with ASC 606. Private companies do have an extra year to adopt the standard, but that doesn't mean you should be dilly-dallying. There are 2 types of implementation methods, the retrospective and modified retrospective approaches. The full retrospective approach requires you to report all contracts for the 2 full periods prior to the report date, meaning you have to be able to rerun every transaction for the past 2 years under the new guidance. This takes a lot of prep work, but can be very rewarding, especially in understanding the differences between old GAAP practices and new GAAP practices, you know, and seeing how they affect your bottom line. We have very few customers adopting the full retrospective approach, actually, and it took a ton of careful upfront organization and resource allocation from those accounting teams, IT teams, executive teams, our implementation teams, everyone. So there are resource constraints that need to be considered when you're looking at which approach to consider. There is, however, that second option, the modified retrospective approach, which allows you to adopt the new standard only for contracts that begin on or after the effective date, as well as make changes to beginning retained earnings for other open contracts. This can certainly relieve some of the pressure of restating all your contracts for the last few years, but be warned there's a potential for lost revenue in those contracts where the timing of recognition changes under the new guidance to later periods. This ultimately means dual reporting and reconciliation. So you'll have to report a set of books under 605 and a set of books under 606 until all your contracts have been converted into ASC 606 fully, which is certainly something, again, that automated software should be able to help you with, but it's a tedious task. We've actually seen a ton of companies who would have liked to adopt the full method, but then ran out of time and had to divert to the modified implementation approach. So again, as you're beginning your assessment, make sure you do your due diligence and think about the long-term implications of the approach that you'd like to take. All right, so now I'm going to hand you over to Dave, and he's going to talk about the 5 steps of the new standard.
Thank you, Kristen. So on the slide that everybody sees now are the 5 steps and core principles related to the new standard. So on the first one, do you have a contract? So in order to have a contract, the agreement, again, whether verbal or written, must be approved by both parties. Both parties must be committed. There must be identifiable rights and obligations under the agreement, and there must be probability of collection. If we're missing any of these, then you need to defer revenue until control is transferred. There are no remaining obligations under the agreement, and the consideration received is non-refundable. So really, really important to look at all of your written and verbal agreements to make sure you know whether you actually have a contract or not. In the new standard, one has not met the criteria of a contract of collection is not probable. So a good example would be if you sign a contract with a restaurant in an area where restaurants really thrive, assuming you meet everything else in the criteria, you probably have a contract. But if you sign a contract with a restaurant in an area where 99.9% of the restaurants fail, so probability of collection of whatever you're selling is not probable on day one, then you actually don't meet the definition of a contract. So then, step 2, we need to identify the performance obligations. And these performance obligations must be distinct, as defined by the standard, or have the ability to be distinct within the terms of the contract. So I'm going to provide a few examples to try to paint the right picture here. I'm assuming everybody on the phone has rented an on-demand movie from Verizon or Comcast or whoever your cable provider is. So in this case, the only performance obligation that the cable company needs is to make sure that that movie is available for you. So once they make that movie available for you, they can recognize revenue because there's nothing else they need to do. Alternatively, if you buy a license to software and that software has to constantly be modified or updated in order for the customer to benefit from that, then the revenue is actually going to be recognized over time, because in order to meet that performance obligation, the company needs to continually update that software. So then we move to step 3, determine the transaction price. So seems pretty simple, but in practice, we know that there's oftentimes elements of variable consideration. So what are some of those examples? Discounts, volume rebates, performance bonuses, loyalty point programs. All of these items impact the ultimate transaction price that you may get over the long term for the products and performance obligations that you're selling. So it is a actually very difficult process to go through, and as you can imagine, dealing with these in a systems perspective can also be challenging. So once you've gone through and you've determined the transaction price, now you've got to allocate that transaction price to each of the different performance obligations that you identified in step number 2. And there's a couple of acceptable methods of doing that the FASB allows. So one is the market assessment approach. Secondly is the expected cost plus a margin approach. And then lastly, if you're unable to do those first 2, you can use the residual approach in the event that you know the transaction price for 1 or 2, but can't put your finger on the third. And then lastly, you actually go through the process of recognizing revenue as those performance obligations have been met. So at the end of the day, what changes? The timing of when revenue can be recognized. As Rob will talk about in a few moments, the concept of lost revenue. Systems are going to need to be changed. Contracts, the way you draft them moving forward, you might consider changing them. And then when you think about bank covenants that are driven off of net income or revenue, those things could change as well. So at this point, I'll turn it back over to Kristen for another polling question.
Awesome. So I'm going to go ahead and initiate our next polling question. Again, you'll have about 30 seconds to answer the following question. What do you believe the most challenging topic will be regarding the new revenue recognition guidance? increased disclosures, accounting policies and procedures, and revenue recognition, systems and processes, internal controls, or other business implications. All right, I'm going to go ahead and close that and gather our results. So we have 60% believe that the accounting policies and procedures and revenue recognition rules will be the greatest impact. And then we have 41% with systems and processes. I like that answer as a systems person. 23 with increased disclosures, and 20 with internal controls. Only 4% of you selected other business implications. Hopefully my spiel earlier will let you decide that later. But anyways, so, you know, as an accountant, I would certainly agree with increased disclosures, although, again, with most of our audience maybe being private companies, that's less of a concern. So putting our audience in consideration, I would actually believe that the systems and processes would be the biggest challenge. And I'm not trying to be biased in my answer, since I do happen to work for a software solutions company. But I think that the accounting and finance departments are fully equipped with the knowledge and resources to handle the accounting policies because of the people. External finance professionals are always there to support this process as well, just like our friends here at CBIZ. That's their bread and butter. You know what's not most accountants' bread and butter? Technology and systems. So you'll all underestimate the material impact of the changes to your systems because, you know, you're in a vulnerable position where you don't fully understand the limitations that your systems hold. And again, I'm trying not to jump ahead and ruin the surprise for what we'll cover later, but I think involving IT and the executive teams needs to be part of that due diligence that I keep hammering the head on. And implementing the new standard, because systems and processes are such a major key. Okay, enough of my opinion. I'm going to give it now to Rob to start our deeper dive into understanding the new standard for private companies.
Thanks, Kristen. All right, so you know, I think these this slide and the next few slides, I think, just really highlight some of the areas where the new standard provides some fairly detailed guidance. You know, looking at the list here and just kind of scanning through some of these topics, you know, you look at what we'll find is there are some similarities to existing GAAP, but there are differences. You know, you take right of return, for example. You know, when we're accounting for expected returns, the new standard now requires us to record a brand new asset, a right of return asset for the cost of the expected returns. You know, the offset would, of course, be to cost of sales. So that's different. And you know, under the existing standards, we simply don't have to do that accounting. So some differences there. You know, going down a little further, you look at product warranty. You know, if a customer has the option to purchase the warranty separately, generally that's going to be viewed as a separate performance obligation. The guidance provides some specific considerations that we need to make as we evaluate whether or not we have separate performance obligations. You know, is the warranty required by law? The length of the warranty coverage period. You know, a longer coverage period may be an indication of a separate performance obligation. The nature of the task to be performed. So definitely some differences there, and some very explicit guidance within the standard on some of these topics. I won't go through all of them here on the slide, but main message here being that some of these are significantly different from what we are required to do under existing standards. The disclosures, last bullet here on the slide, these are significantly different. And this is an interesting slide because what this does is really summarize some of what we've been seeing as we work with our private clients, just in terms of some of the types of areas and issues that have been coming up fairly often. You know, you look at this first one here, just generally, you know, I think just the general process of documenting the applicability of the standard and how how each step of the new 5-step model applies to your company or your revenue model. The first step, as Dave mentioned, being whether or not you have a contract. Just that step alone has a number of specific criteria that have to be met for you to be able to conclude that you have a contract. So really just documenting how you apply the standard. The other thing that we see coming up quite often with our privately held clients is the area of contract costs, both contract acquisition costs and contract fulfillment costs. These are treated very differently under the new standard. The big one we run into quite a bit is commissions, which is a type of contract acquisition cost. In the past, most companies used to just expense these commissions as the salespeople earn them. The new standard requires that any such cost be capitalized and amortized as you recognize the revenue. So clearly a difference there in the accounting. Going down a little further, another area that we've seen come up quite a bit is the whole area of contract assets. This is a whole new concept under the new standard. We simply didn't have this asset before. And these can arise when, for example, you have a right of return liability that you're recording. You record a contract asset. If an entity satisfies a performance obligation in advance of receiving payment, and there are other obligations remaining under the contract, you might be required to record a contract asset. Contract assets are different from accounts receivable, and that's important. That's a separate asset required to be presented separately. So that's come up quite a bit. The other thing we run into here is acceleration or deferral of revenues. So as we analyze some of these contracts, and we're seeing this come up quite a bit, revenue, for example, could be deferred in certain, say FOB shipping point arrangements when those costs are incurred after the customer obtains control and the accounting election is made. Because keep in mind that the new standard in these situations where you have FOB shipping point, new standards allows you an accounting election where you can treat those costs incurred after the customer obtains control as either a separate performance obligation or a contract fulfillment cost. So definitely some judgments there, and that's a difference that we're finding our clients are having to deal with. We have other situations where the revenue, under the existing standard, the price wasn't fixed or determinable, and so the revenue had to be deferred. Under the new standard, you're essentially forced to come up with a transaction price, and this effectively accelerates recognition in many cases. So we're running into that. And then I think Dave mentioned earlier that the concept of lost revenue. This is important. And companies need to understand the implications of the method of adoption that's chosen. Now, depending on which method you choose, you could have revenues that never get reported on any income statement. Keep in mind that the two acceptable methods for adopting are the retrospective versus the modified retrospective. So just to put this, just to illustrate this point of lost revenue and take a look at how this might work. Let's pause for a minute and think of a private company that has a 2-year contract for $1 million, where under today's standard, revenues recognized $500,000 in 2018 and $500,000 in 2019. So $1 million contract. But under the new standard, revenue would have been recognized $1 million in 2018 and 0 in 19. Let's say this private company adopts the new standard in 2019 as required. Under the retrospective approach, where both years would be presented under the new model, this company's income statement would report $1 million in 2018 and 0 in 2019 under the new model. So the entire million gets shown in 2018's income statement. However, under the modified retrospective approach, where 18 would be presented under the old standard and 2019 under the new standard, this company would report same transaction. The company would report 500,000 in 2018 and 0 in 2019. What this means is that we just had $500,000 worth of revenue that never makes it onto any income statement. And so, you know, as we mentioned, you could have revenues that are lost as it's described under the new standard. So important concept and just something to think carefully about as we think about the adoption method to use. This next slide here just really sort of summarizes how the standard may affect different industries. And the message here is that the impact will be different based on the industry you're in. You know, you look at, you know, manufacturing. These are some of the issues that we've seen come up with the manufacturing clients. You know, you take long-term production contracts. You know, for certain orders that may be highly customized, if the customer controls the asset during production and the asset has no alternative use, you may be under revenues that have to be recognized over time. Under today's standard, you'd normally complete the order and ship it and recognize revenue then. Under the new standard, you may have to begin recognizing revenues as you're producing the asset. So, you know, so that's different. So the effect is different. Shipping terms, you know, companies may want to take a look at that. I mentioned the FOB shipping point arrangement. There's an accounting election, and that's an important judgment to make. And this is for any costs incurred after the customer obtains control. Service companies, the effect is maybe slightly different or in some different areas. A lot of these arrangements have performance bonuses and or penalty. And so, you know, that brings into play variable consideration, which has to be calculated by one of the two acceptable methods. Commissions, you know, technology companies have a few areas that may be affected more significantly. A lot of these bundled arrangements for the technology companies may have had elements where the price wasn't fixed and determinable, and so the revenue has to be deferred. You know, we may be able to accelerate some of those revenues under the new model. Sales commissions is also a big deal. For certain type of SaaS arrangements where we used to expense those commissions, those now have to be capitalized and recognized over the term of the arrangement as the revenues are recognized ratably. So again, the main message here is that the impact really will vary based on the industry. So I'm going to pause here and really just turn this back over to Dave to talk a little bit about how systems might be affected.
Thank you, Rob. So we're going to walk through an example of a company that sells widgets, but also has a loyalty point program. And it'll kind of bake in both the accounting for revenue rec as it relates to loyalty programs, as well as the impact that it will have on systems. So in the first slide, a sales order is created by our company in December, and then shortly thereafter, we ship our widgets to our customer. So next slide, please. So under the old standard, we would have recognized 100% of the revenues, you know, post the widgets being shipped. And the loyalty program would have been accounted for as a separate accrual or a cost accrual. But now, under the new standard, we have to take a hard look at that loyalty program and ask ourselves the question, does the customer receive a material benefit from the loyalty program? And in this case, we're going to assume the answer to be yes. And what that means is, do they have a material right through the loyalty program that they otherwise would not have? And a good example of this would be, if I had a loyalty program, but I also routinely issue coupons for the same exact benefit, then that loyalty program really doesn't produce or provide a material right, because one can go get it from the coupon. But if we didn't issue coupons and the only way to get that benefit was through the loyalty program, then it would be a material right. So the next step is to calculate the amount of revenue associated with the sale of the widget that should be allocated to the loyalty program. And as I talk about this and think about it, you got to think about, how is this going to work in my systems? How am I going to track it? How am I going to calculate it? So an example of how you would calculate the reward would essentially be the standalone value of the loyalty benefit being provided. So for example, if the loyalty reward was for a 40% discount on a future purchase of the same item, but I happen to be running a 10% offer at the same time, then the actual incremental amount that I would defer would be the 30%. Again, very complex when you think about systems and tracking. And then, thinking about, how do I do that? How does the system calculate it? And how do I track future redemptions on that loyalty program? Again, all is going to impact process and systems. So as the customers over time begin to redeem their loyalty points is when you would ultimately recognize that revenue that you had deferred. So you can see up on the timeline, the customer pays the invoice, the supplier receives payment, and then again, as you redeem those, or the customer redeems those loyalty points, that deferred revenue is going to flip into revenue. And you'll also, as a company, you'll recognize the cost of the items that are being shipped. And actually, this slide is kind of recaps exactly what I just said. So thinking about what should be a very simple process can actually be quite complex as far as tracking, calculating the amount of deferral, estimating the amount to be realized over time. And then the standard also requires you to factor in breakage. So as you think about that amount initially being deferred, if it's probable that 20% of the loyalty points will never be redeemed, you don't actually have to defer that full amount. And if your assumption on breakage changes over time, you've got to adjust that liability over time. So very, very complex and a lot to do. So with that, I will turn it back over to Kristen.
Awesome. Thank you, Dave. I love this slide because I think it summarizes your example really well and just reinforces again how big of a deal this can be. Just the fact that revenue recognition may no longer occur at the time of invoicing can, be a really big disruption for systems and processes. These complexities and challenges were applicable to the software industry sometimes before the new revenue guidance came out. So here at SOFTRAX, we have historical experience with this, which is exactly why our solution is designed in a modular format. By modular, I mean it's just a fully agnostic software tool designed as a subledger. So we separate that order to cash and order to revenue processes in order to separate the billing events from the revenue recognition process. So if you think back to the example that Dave just walked us through, that invoice was created, but the revenue is still on hold for the satisfaction of those loyalty points. Revenue recognition software was designed to handle both of these events, although they occur at different times. So separating the revenue recognition process, again, from that invoicing event supports forecasting and recognizing revenue with varying schedules. So if you have various revenue items that make up one performance obligation and, one's being recognized point in time and the other's being recognized over time, you can see the differences there. Also, just a few additional considerations to kind of throw at you here. What if this contract was done in a different functional currency? What if we're now in a multi-currency situation? What if this contract subsequently went through a contract modification where you added or subtracted some of the items within the order? These scenarios can get really complex and end up taking a ton of resources to accomplish compliance, which is, again, why I warned you about that material impact at the beginning. So before we walk through anything else, I'm going to submit one more polling question for you guys. So again, please take another 30 seconds and we will gather those results. So the question is, how is your company planning to handle compliance with ASC 606? So now that we just walked through a systems and processes section in our slideshow, I'll be interested to see what comes up here. The options are Excel, ERP system, revenue recognition software, or you're not sure, or none. I'll give you folks a couple more seconds to answer. We're Getting the majority of people answering here. All right, I'm going to go ahead and close it and share those results with you guys. So we have 33%, the majority is with ERP systems, 27% is not sure or none of the above, 23% with Excel spreadsheets, and 17% with revenue recognition software. So I guess kind of ignoring that 30% who's not sure or none of the above, because I'm really curious as to what you're doing if you're doing none of these three things. The winner is the ERP system. I am actually surprised if you have a material impact, which most of you said you had a huge accounting policy change at the beginning, are handling this in your ERP system. The next one is Excel spreadsheets. And just to focus on that one, I'm actually writing a blog series on avoiding Excel for compliance with ASC 606, so shame on all of you who chose Excel. I'm kidding, of course. But using Excel for compliance is what we call the brute force approach because of the unfortunate limitations, or more like frustrations, that are inherent in using Excel spreadsheets. And it all boils down to one fact. Excel is not secure. No matter what passwords you protect it with, Excels are difficult to share, difficult to keep track of, and completely lack audit controls and audit trails. So the risks are endless. And what pairs really nicely with insecure processes and systems? Humans, of course. Add the risk of human error into that mix, and you have a solid recipe for disaster. Now, I'm not going to quote my blogs. You should go read them on our website for yourself. But the number of company-wide tragedies due to Excel errors is far too high to ignore. So the 25% of you dealing with this in Excel spreadsheets may want to reconsider. Not to mention they're incredibly tedious, but don't get me wrong, I love Excel. I'm definitely a numbers and charts kind of girl, but at the end of the day, I don't want to adjust currency translations or calculate the time value of money or run renewals for thousands of contracts in an Excel. No way. All right, so another viable option that you guys are choosing here is that familiar ERP system that already houses all of your data. But be honest with yourself. Dave proved that separating the revenue recognition and invoicing events is critical in ASC 606. And many ERP systems aren't set up to support that. So sure, you could try to reconfigure that entire system to pull together some kludgy process to handle it, and maybe even support it with external Excel spreadsheets. But you'll still be stuck managing the data rather than managing the revenue, which I mentioned again, not ideal. So, not to be a sales engineer for a revenue management software company or anything, but make sure your systems are set up to handle the new guidance as part of your assessment. It's really important. Not only do you, but your auditors and your external shareholders will care. I briefly mentioned Excel's lack of audit controls because, let's face it, we're accountants, and that's what it comes down to, auditor and shareholder approvals, which is actually what Rob is now going to walk you through. A few auditor and prepare considerations.
Thanks, Kristen. So this next slide here really, I think, summarizes some of the concepts and the areas that both auditors and management at audit clients should be thinking about. As we look down the list here, just in general, this is a principles-based standard. So there are a lot of estimates and judgments that need to be made. And so, it's important to at least have a working knowledge of the standard and just kind of understand the overall process. You get into the area of contracts. Auditors are going to be concerned about that, from, contract modifications, combining contracts. You have multiple contracts with the same vendor. The collectability criterion in particular, as you look at the criteria that all have to be met for you to be able to conclude that you have a contract. And keep in mind, all the criteria have to be met for a company to be able to recognize revenue, even in instances where the customer has made a payment. And so, that's an area to which some attention will need to be paid. The transaction price and how that's calculated. The whole concept of variable consideration is fairly new for most accounting departments. And so, auditors are going to have to assess the choice of the method for calculating the transaction price. And keep in mind, there are only two acceptable methods. There's the expected value method when you have a range of likely outcomes, and the other method would be the most likely value method when you have one of two possible options. And the standard makes it clear this is not meant to be a free choice. So companies don't get to choose which method better suits them. A judgment has to be made as to which method is most appropriate for the situation. And so, again, very judgment-based, principles-based, and auditors are going to have to assess some of these judgments that have been made. Some other areas, non-cash consideration, situations where you have consideration payable back to a customer, those are important. Allocating the transaction price, and really how standalone selling prices were determined. So that's another area as we think about the audit. And then recognizing revenue and how performance obligations have been satisfied. Should the arrangement be recognized over time or at a point in time? And if it's over time, what's the method for determining progress towards completion? And you have a number of input methods that may be used as well as output methods. And so another set of judgments there that have to be made. So yeah, so a lot of areas here that are going to be interesting for both management and the auditors. And so in general, the other thing to think about is we mentioned earlier, just transition and thinking about what's going to be most appropriate for each reporting entity. Full retrospective versus modified retrospective. And we talked about the lost revenues example earlier. Next section here just really highlights some important definitions that are new for many of us. This whole concept of contract asset, which is a right to consideration in exchange for goods or services that have been transferred to a customer. It's a new asset that has to be reported. This asset is different from a receivable, which is also a right to consideration, but this one is really only conditional on the passage of time, no further obligations under the arrangement. And so contract assets are required to be reported separately from receivables. So that's under the new standard is an explicit requirement. Contract liabilities, another item that's new and required reporting. Keep in mind, you can present contract assets and liabilities net on a contract-by-contract basis, but they're never netted against receivables or other assets, really required to be presented separately. So that's new. As we move through here and start to talk about disclosure requirements, I guess the main message here is that the disclosures in general are much more extensive under the new model. But what we try to do here on these next couple of slides is really just highlight the differences in the requirements for a public entity versus private entities. As we look through, what we did is we highlighted in red the requirements that would not be applicable for private companies. So going through, we have disaggregation of revenue, that's a requirement, but private companies don't need to report the quantitative disaggregation. And then going through information about contract balances, performance obligations. The next slide here talks about remaining performance obligations, significant judgments, interim requirements. And as we look at the items that are highlighted here to kind of show us the differences, what we're getting from this is that while the disclosures are more extensive, they're not as onerous for private companies. Just a lot more extensive for public companies and frankly requiring a lot more resources to track and properly report them and disclose. So just to sum up here, here's what we learned as we took a look at the disclosure requirements under the new standard. They're much more extensive, and so it's very hard to kind of mask the accounting. They're much more important under the new model. lot more emphasis on the disclosures just because of the high degree of judgments that have to be made. And in fact, the SEC has emphasized that the expectation is the same for private companies as it is for public companies. So, they're not going to give us a pass on, the requirements for disclosures. The other thing we learned here, based on the 2017 filings of the entities, public companies who adopted early, is that the disclosures went from something like a couple of paragraphs for some to 5 to 6 pages under the new model. We had the benefit of looking at the 10Ks for the early adopters. We had several companies adopt early: Raytheon, Alphabet, Google, First Solar, United Healthcare, General Dynamics. These are all companies that adopted the standard early. So we had a chance to look at what the difference was versus their prior year filings. So that was interesting. The other thing we noticed here is that the disclosures tended to emphasize what the items that were important to that particular business. For example, for Raytheon, they really spent a lot of time talking about how they combine contracts, probably because they have multiple contracts with the same vendor or the same sets of vendors. Whereas Google would spend a lot of time disclosing information about principal versus agent considerations. Again, probably because they act as the intermediary in many transactions. So that was another interesting observation as we looked at these. The one thing that came out loud and clear from all of these entities is that the time, the resources, and the systems that were necessary to comply were grossly underestimated. Just about everyone said they had no idea it would take as many resources as was required. So that, just a few thoughts there about disclosures. What I'll do now is I think turn it back over to Kristen. I think, Kristen, do you have another polling question?
I do. I've got one more for them. Okay. Thank you, Rob. So our final polling question, again, guys, I'm going to give you about 30 seconds to please answer this last poll, and then we'll talk through our last section with Dave. You're okay. We got about 7 minutes. All right, I'm going to give you guys a couple more seconds, and then I'm going to close this last final poll. So if there's anyone who hasn't voted, get your votes in so you can get that CPE credit. All right, I'm going to close and share those results with you guys. So our winner is no, not yet, to does your company expect to hire additional resources to assist with implementation? 33% or 32% no, not yet. 25% yes, externally, that's a good sign. 18% yes, both, and 17% no, not at all necessary. And then a small 7% with internally. Yeah, so, as we've covered throughout this entire presentation so far, and actually what Dave's going to hone in on in this next section, is that this change to the new standard will really require a lot of attention. And that ranges from hiring those external auditors or assessment companies like CBIZ to perform an initial assessment of your current and future revenue management practices, to hiring accounting IT consultants or solution implementation experts to help you get through the final implementation and auditor approvals with your new system in place, again, to training employees on the new systems and processes. And in my experience, most people would answer yes, both, because they've really underestimated the impacts, and now they're making these sweeping changes in a big way to come up with quick solutions. I think if you're not at all considering hiring additional resources to assist with your implementation, then that's very bold. Good luck. I hope you did your due diligence there. All right, so I'm now going to hand it off to Dave one more time to talk you through some of those implementation considerations.
Thank you, Kristen. We're down to our last couple slides, and thank you everybody in the audience who's been patiently listening to our presentation. So now that you've heard all about the standard, we want to take a step back and think about your next steps. First and foremost, performing that initial assessment of contracts is critical. And in order to do that effectively, we believe you need to create a task force of finance and non-finance people so you can make sure that you're actually collecting all of the contracts that could be applicable under 606. Another key step is essentially educating those in your organization. So educating those in sales, in marketing, in legal, those people who are actually part of the teams who create the contracts and who are involved in negotiations. If they're better educated, your result can be much better. Getting IT involved is also critical because they'll be the ones helping you design, implement, and provide ongoing support in the system for revenue recognition. Being educated enough to know all of the benefits or risks on the adoption approach, as we discussed before, is critical. The last thing you want to be doing is sitting in an audit committee or board meeting, and then your board or your audit committee completely not understanding, what just happened to their sets of financial statements. So educating them as well is very important. And lastly, developing a plan, a project plan, and having a project leader, we believe is paramount to have the right experience and to make sure all of the parties within your organization are kept organized, the implementation process is tracked, and ultimately implementation can be successful. So we're on to our last slide here, and I know there's been a ton of information. So we just want to know that, or we want you to know that here at CBIZ, we would love to be the ones to help you perform the assessment, to analyze your options, and then, we can assist in the training of your accounting folks, in your accounting teams. We can help you review contracts, both executed and those that are in the process of being executed. We can help you with the actual implementation approach, recording of journal entries, as well as working with your organization and selecting, a software or, alternative IT provider such as SOFTRAX. We can also help you document for your standard operating procedures or new accounting policies, your internal control documentation, really from soup to nuts. We're doing it now with our clients, and we'd love to be able to help you. So again, thank you very much, and I'll turn it back to Robert.
Yeah, no, Dave, I think you summed it up nicely, and I'll just close with a quick comment here. And this question comes up regularly from clients. How can you help? What's the approach? And I guess I'll just leave you with kind of how we approach these generally. And what we do is we just start with an example of each type of contract. We run it through a model, and really the objective here is to document just how we considered and applied each requirement within the standard that might be applicable to that company, and really think about the process of getting audited as we document. So that's all I had. Let me I'll close off now, and I know Kristen, you need to wrap up with some comments on admin.
I do. And there were a couple of questions that came in, but just to be respectful of everyone's time, we only have a minute left. I'm just going to go ahead and wrap it up. And for those of you who submitted your questions, thank you. I promise I wasn't ignoring them. I did see them. We promise to send out email responses to you. I did have a question come in and ask about our blog. So I will be sure to also send that link out as well, and other CBIZ resource links if you guys would like them in just a one-page email or something like that. I will also have an email that will come out to all of our participants today, just a quick survey, just so we can continue gathering those survey results and make sure we have the most up-to-date information for you guys. So we would really appreciate it if you could answer that quick survey for us. Otherwise, that concludes our webinar. Thank you so much for listening to today's presentation on ASC 606 with that focus on private companies. If you are eligible for CPE credit, we will be distributing those certificates as soon as we can. I have gathered all the data for those, and I'll send them out. We will also be sure to send out responses, again, to those questions as soon as possible. In the meantime, if you'd like to download the presentation slide deck, you may do so at this time in the bottom corner of your GoToMeeting in the handout section. I'd like to take a moment to thank my co-hosts today, Dave and Rob, for a job well done. Thank you very much. You provided a well-vetted and thorough overview for the audience, and I really appreciate your time. I hope you all will join us again. Please check out both of our websites and social media pages for updates on upcoming events and webinars. And please feel free to send us an email if you have any other questions. Thank you guys so much again.
Thank you.
Thanks.